Hey everyone, today we're taking a laid-back but deep dive into range trading, a foundational skill for any trader. We're going to take it slow, break things down, and make sure every concept clicks. You'll learn the essentials from spotting ranges to understanding how price moves within them. So grab a coffee, relax, but focus. And let's get right into how range trading can become one of the most powerful tools in the market. For starters, let's talk about what is a range. A range occurs when the market moves sideways, trading between two boundaries. The top boundary is called the range high and the bottom one, range low. The midpoint between these is known as the mid-range. When the price trades in the upper half of the range, we consider the market bullish. Conversely, when the price is in the lower half, the market is generally seen as bearish. Ranges typically occur after an impulsive move in the market, namely after a sharp move down or up. The price begins to stabilize and move sideways. This is when the range forms. There are many patterns you might see on the chart, but 4 key scenarios help us identify when a range is forming in the market. Let's break it down. The first scenario is when a range appears right after an impulsive move. This setup is straightforward. After a sharp move down, the lowest point before a bounce becomes the range low, and the highest point after the bounce is the range high. The same principle applies to an upward impulse. After a strong move up, the first high is the range high, and the first low following a rejection becomes the range low. Simple as that. The next scenario occurs when the first low or high before a bounce is taken out by the price. After a strong downward move, we initially label the first low as the range low, and the high after the bounce as the range high. However, if the price dips below this initial low, it's no longer a valid range low. Instead, we use this breached low, as it represents a point of liquidity. Liquidity and stop losses are essential concepts related to ranges, which we'll explore in more depth later. And this principle also applies in reverse for upward moves. If the first high is surpassed, we then take this breached high as the valid range high. In live markets, begin by identifying the most distinct highs and lows on higher time frames. For instance, highs on 1-hour chart might seem important, but if you zoom out to a 4-hour or daily chart, those highs may blend in a single, larger candlestick. The most isolated highs and lows on these larger time frames should be your main reference points. And when selecting a range, make sure it aligns with the overall price action. Notice how the price interacts with the mid-range. Does it act as a key level? Look for overlap with other major levels like weekly or monthly opens. For example, if your range high matches Monday's high or your range low aligns with Monday's low, it adds strength to that range. Always rely on logical overlaps to choose the best range. Now let's talk about liquidity, a crucial concept we need to know in order to help us understand how ranges occur. So liquidity refers to the ease with which trades can be executed without causing significant price movement. Bigger players like institutions or whales operate with much larger order sizes than retail traders, and they require liquidity to fill their orders. When they buy, they need to be enough sellers in the market to match those purchases and vice versa. When large players place trades, their effect on price reveals the market's liquidity. If a large trade significantly moves the market, it indicates an illiquid market. In contrast, if the price barely reacts, the market is considered liquid. Liquidity often accumulates above key highs and below key lows where stop losses are placed. Those areas attract price because they represent pools of buyer-sell orders. For example, traders who are short place their stop losses above key highs, while long traders place them below key lows, assuming these levels are safe. Larger players often target these levels to fill their orders. When price reaches a cluster of stop losses above a high or below a low, this is called a liquidity sweep. For instance, when price briefly spikes above a key high to trigger stop losses and then reverses, it's called a high sweep. Similarly, when the price dips below a key low, triggering stops before reversing upward, it's a low sweep. You often hear me talk about sweeps. This is when liquidity is taken from above highs or below lows typically leading to a market reversal. Here's an example of how liquidity builds. Imagine the price is trending downward, creating lower highs. Traders shorting each lower high place, the stop losses above those points, causing liquidity to accumulate above them. Simultaneously, as price reaches a key low, stop losses from long traders build below this low. Once price hits the key low, it may accelerate down, taking out stop losses below the low, then reverse direction and sweep all the high liquidity that has built up at the previous lower highs. The reverse occurs when price creates higher lows. Traders longing each low place stop losses below them, building liquidity beneath those levels. And when the market accelerates upward and sweeps a key high, it may reverse and quickly take out all the lower liquidity by sweeping the stops below the previous high lows. Alright, let's move on to OTE, Optimal Trade Entry. As a vital tool for range traders, it refers to a specific retracement zone on the Fibonacci scale, offering an ideal entry point for trades. OTE is derived from 0.705 Fibonacci level, which sits between the 0.618 and 0.786 Fibonacci retracement levels. This zone, especially the 0.705 level, provides a sweet spot for entering a trade. Traders use this zone to anticipate a lower high or higher low, depending on the direction of the market. Imagine the price is trending downward, forming a high and a subsequent low. As the price retraces from that low, traders draw the Fibonacci level from the swing high to the swing low. The OTE zone falls between the 0.618 and 0.786 levels, with 0.705 being the focal point. As price retraces back into this zone, it often provides an ideal short entry, offering a high probability setup for traders aiming to ride the next leg down. And in an uptrend, the process is obviously reversed. You should draw Fibonacci levels from the swing low to the swing high. As the price pulls back, the OTE zone between the 0.618 and 0.786 levels often offers an entry point for long positions. And here is an example. After a nice upward move, the market starts to pull back. Instead of chasing the price with the FOMO long, a disciplined trader waits for a retracing to OTE zone. Drawing Fibonacci from low to high, the OTE retracement between the 0.618 and 0.786 levels represents the perfect entry for a long trade at the 0.705 level. And as you can see, the price bounces nicely off this level, providing a high probability trade setup. One more fundamental concept related to ranges involves two key elements: supply and demand. These terms can have various meanings, but here's how I approach them in the market. Supply and demand zones are areas of sideways price action that occurs before a significant move, either up or down. Demand is the sideways price action before a pump. Supply is the sideways price action before a dump. Simple. And here is an example in the live market. After some sideways price action, the market rallies upwards. When the price retraces, it bounces exactly from the sideways zone, showing that demand was present at that level. This is where buyers step in to defend their previous positions. Now, other example, price moves sideways, then dumps sharply. When price returns to that zone later, it faces rejection and resumes its downward movement, showing how sellers defend their previous positions in that supply zone. Let's move on to breakers, a concept that applies when supply or demand zones are violated. A breaker occurs when price breaks through a supply or demand zone. For demand, if price fails to bounce from a demand zone and breaks below it, this zone can act as a new resistance. For supply, if price breaks above a supply zone, that zone can turn into a new support. Let's see them in action. In a demand zone, buyers accumulate positions, expecting price to bounce. However, if price breaks below the demand zone, those same buyers may want to exit their positions, leading to selling pressure. This causes the area to act as resistance when retested. Conversely, if price breaks above a supply zone where sellers were accumulating, those sellers may want to exit their short positions. This creates buying pressure when the price retests the former supply zone, often resulting in a bounce and new highs. So, understanding supply and demand zones and recognizing when these zones break, forming breakers, is key to identifying high-probability trade setups. So by using these zones effectively, I can anticipate bounces, rejections, shifts in market structure. Now we can talk about trading setups, which is a critical part of my approach. One of my trading strategies is heavily based on liquidity and the ranges I draw, which revolve around key highs and lows. The goal is to capitalize on how liquidity behaves at those levels, especially when stop losses are triggered and the price reverses direction. Look at price range with a range high and a range low. When the range high gets swept, for example, price briefly exceeds the high, I typically look for sell opportunities, and in this scenario liquidity is drawn towards the opposite side of the range, meaning that after sweeping the high, price often reverses and moves towards the range low. The same applies in reverse. When the range low gets swept, I look for buy opportunities as the draw on liquidity shifts upwards towards the range high. In some cases, you can blindly sell or buy into a sweep, assuming that price will instantly reverse after taking stop losses. For example, if price sweeps a range high, you may choose to short the market immediately, expecting it to reverse. Alternatively, you can wait for confirmation after the sweep. This means waiting for price to break back inside the range, signaling weakness after a range high sweep or strength after a range low sweep. When you get confirmation, you can enter with more confidence. This method adds an extra layer of safety since you avoid entering prematurely. Once price has shown a clear sign of reversing after the sweep, your trade has a high probability of success. Now, why do I often target just the opposite side of the range instead of extending my targets? This is closely tied to the concept of liquidity and how price behaves. When price sweeps one side of the range, for example, lows, it tends to get drawn towards the other side. So, in example, to the highs. However, once the liquidity has been taken, price frequently chops around in the middle of the range. So by targeting the opposite side, you're focusing on the clean draw on liquidity, where price is more likely to move smoothly. And once the liquidity is taken, exiting the trade is often the best choice to avoid being caught in the chop. This is the foundation of how I trade ranges based on liquidity sweeps. As mentioned earlier, it's not just about blindly buying or selling when price sweeps the range boundaries. A solid strategy takes more, and this is where Confluence comes into play. Confluence means finding multiple reasons to support your trade idea. You want to gather as many signs as possible to strengthen your position, whether you're looking for longs or shorts. Here's an example. Price moves sideways, forming a range, and after a pump, price retraces and sweeps the range low, lining up with an OTE and demand zone. And since the range low has been swept and liquidity is now drawn to the upside, this offers a strong long opportunity. Depending on how confident you are about price reversing from your target area, you can choose to wait for confirmation. If the confluence of factors is high, example a key monthly or weekly open, sometimes it's better to enter the trade right away with a wider stop. For example, if price sweeps a range low and aligns with demands and OTE, you could place a wider stop and allow the trade to play out. Once price reclaims the level, you can use trail stops or even add to your position as it moves towards the range high. In these setups, liquidity draws to the other side of the range, but since there is a strong demand and the trend is upward, you may want to take partial profits at the range high, while leaving some of the position open for higher targets. This applies equally to downside trades. When price is trending lower and sweeps the range high, drawing liquidity to the downside. Take off a portion of your position as price approaches the range low, but leave some of it running if the trend is clearly continuing. As you can see from here, price consolidated, then made a strong pump, a clean range formed, and price swept the lows, deviating just enough to reach the OTE and demand zone. And this provided a strong long opportunity, with stops placed below demand and OTE targeting the highs. In this scenario, you could have waited for confirmation. Price retested the range low, and with your stops below, the trade offered a great risk-to-reward ratio. Obviously, each setup is unique, but the underlying principles remain the same. Get confident in your trade positions, combining factors like range sweeps, OTE levels, demand-supply zones, and confirmation. After both the range high and range low have been swept, the market often loses a clear draw on liquidity, leading to choppy price action, or how I refer to it, a played-out range. This is why I typically step back at this stage and avoid overtrading. Without a strong liquidity draw, the market tends to range aimlessly until it breaks out and initiates a new significant move. If you still want to trade in these conditions, focus on scalping opportunities, but only at the extremes of the range high and range low, where Confluence is strongest. Avoid trading in the middle, where the price tends to chop around unpredictably. For example, let's say the range high and range low have been both swept and price is chopping around again. If price sweeps the high into an OTE level and range high, the local draw on liquidity will shift to the downside, signaling a short opportunity. Your stop loss should be placed above the OTE or range high, and your target will be the range low or other liquidity resting lower. In this case, use OTE to measure from the swing high to swing low, looking for shorts on the retest after a high is swept. This setup offers a clean entry and exit strategy with a favorable risk-to-reward ratio. It's important to note that market behavior has evolved over the years. Previously, you could simply wait for a candle to close back inside the range after a sweep and enter a trade confidently. Nowadays, this pattern is less reliable and you're more likely to see deviations, where price spends time outside the range high or low before reclaiming it and moving back inside the range. These deviations can still provide solid entry points. Whether it's a quick wick or price spending time outside the range, both ultimately signal the same liquidity sweep. What matters is recognizing the sweep and preparing for the market to reverse back towards the opposite end of the range. Like here, we had an impulse move up, forming a range high and range low. After sweeping both the high and the low, price bounced back into the middle of the range, and using OTE from the high to the low, we would look for a short entry near the OTE and range high. And once price sweeps the high, we wait for rejection, short with a stop above OTE and target the lows. As shown, even if you blindly short the OTE with stops above the range high, the risk-to-reward ratio stays above 2 to 1, which is more than acceptable. The key takeaway from trading played-out ranges is patience. Always prioritize clean invalidation above your stop and target liquidity resting at the other side of the range. The mid-range, or the halfway point between the range high and range low, plays a great role in determining continuation trades, whether the market is trending upward or downward. Here's how I utilize the mid-range in both bullish and bearish scenarios. When the market is trending down and starts retracing upward, I pay close attention to how price behaves around the mid-range. If price sweeps a previous high but fails to hold above the mid-range and breaks back below it, this signals that the draw on liquidity has shifted downward. At this point, the market is back in bearish territory and the probability of a further decline is higher. Once price breaks below the mid-range, I look for short opportunities with stops placed above the range high. The reason is simple. The trend is down, Liquidity has been taken to the upside, and now price is likely to target the range low or even lower liquidity resting below key levels. And as always, the first target should be range low, but you can look for additional targets based on key lows from previous price action. Take profits at each key low as the price moves in your favor. So summing up the takeaways for the mid-range trading. In bearish markets, wait for price to sweep a high and break back below the mid-range to confirm bearish continuation. Target the range low with stops above the range high. In bullish markets, look for the price to sweep a low, break back above the mid-range and signal bullish continuation. Target the range high with stops below the range low. Both key highs and key lows are pivotal in defining where price will be drawn next, based on liquidity. Take profits progressively as price approaches these levels. This method of using the mid-range to confirm continuation plays is effective simply because it aligns with natural price movements toward liquidity, while offering clean invalidation points at the range extremes. Finally, let's talk about what increases the probability of a range-based trade success. Here it is. Always respect the trend. If the market has been in a bearish trend and begins ranging, shorts have a higher probability of success. Similarly, in a bullish trend, longs are more likely to succeed. And as discussed earlier, understanding where liquidity is resting is key. Focus on key highs and key lows. These are the areas where stop losses are usually clustered, providing the best opportunities for trades. If lows have been taken, look for long opportunities. If highs have been taken, look for shorts. Don't overcomplicate it. Look for the most logical support and resistance levels where price has been interacted multiple times. Sweeps of highs into these resistance zones or lows into support zones offer solid trade setups. That's it for today's video. I hope you enjoyed it and more importantly learned something valuable. This is how I approach the markets based on my personal experience and what has worked for me over the years. Everyone trades differently and this is what suits my style. If you'd like to support my work, consider using one of the exchange links in the description or join my free Telegram channel. It's in the description again. It's completely free and it's a great place where we share ideas and insights with like-minded traders. Thanks again for watching, and who knows, maybe I'll make another educational video as such soon.